With the coronavirus pandemic wreaking havoc on businesses across the planet, the global market was bound to crash. Finance giants like Ray Dalio predict that it's going to be worse than the Great Depression. During this crisis, investing can be quite tricky. But the truth is, not everyone is losing money. Some people are making profit hand over fist right now. And in this episode, we're going to tell you the 7 best investment strategies to follow during the recession in order to make as much profit as possible or at least minimize the losses. Let's get into it. Number 1. Don't dump all stocks. When a recession hits, stocks underperform in the short term. And while it might seem like a good idea to sell all the stocks in your portfolio, selling at low prices when they're down is rarely wise. If you're too worried about the everyday fluctuations in the stock market, it may be a good idea to cut back on your exposure to stocks. Recessions are somewhat of a cyclic occurrence in the market. In fact, there have been 33 recessions in the United States since 1854, which roughly translates to about one every 5 years. And investors who held onto stocks or bought the dip eventually came out ahead every time. Number 2. Continue to invest regularly. With stock prices decreasing by the day and the economic forecast seeming dire, you might feel compelled to abandon your normal investing habits and save some cash, but that's rarely a good idea. Although you won't be losing any money, you also won't be making any, and you'll lose real value due to inflation. So whether you're contributing to a retirement fund or a regular brokerage account, it's wise to continue these contributions, especially during a recession. The concept of dollar cost averaging, particularly with stocks, is that you're buying shares at regular intervals regardless of the price. Generally, you buy shares at higher prices when the economy is flourishing and at lower prices during a recession. This reduces the impact of market volatility on the overall purchase. And as you buy lower, you're averaging the price lower, which can boost returns in the long term after the market recovers. Number 3. Assess your risks. Think about how much risk you can take on at present. This depends on your investment horizon, job security, and attitude toward risk. A general good rule is, if you're nearing retirement, you should have a smaller share of risky assets in your portfolio. But if you just enter the market as a 20-something, you can take on more risk because you have the time to recover from market crashes. Number 4. Don't put all your eggs in one basket. Not only is it nearly impossible to time the market correctly, it's also difficult to predict which asset class will perform best in any given year, whether it's shares, bonds, cash, or any other. Last year's best performing asset class can be next year's worst, or vice versa. Diversify your investments and create a portfolio based on your risk tolerance, time horizon, and investment goals. However, it's important to understand that this doesn't eliminate risk completely. Even with a well-diversified portfolio, you can't entirely avoid volatility. Your investments can still experience periods of what you may consider as underperforming. But a spread risk means you significantly lower the chance of losing everything. Number 5. Reassess your holdings. Everything looks like a good investment when the economy is booming, but when a recession is at the door, you should take a fresh look at all your holdings and remember why you invested in the first place. Ask yourself what your thesis on each stock was when you bought it. Has the economic collapse fundamentally changed that thesis? Or has it simply created a short-term obstacle for the company to overcome? For example, the coronavirus sell-off hurt the near-term outlook for Apple, but iPhone demand will eventually be just fine in the long term. Rebalance your portfolio to return your asset allocation to its original targets. For instance, if your original target allocation is 60% stocks and 40% bonds, chances are your stock allocation is lower and your bond allocation is higher during a recession. If you rebalance your portfolio in this scenario, you will sell bonds and buy stocks to return to your target allocation. Number 6. Best things to put your money in. Just because the economy is in the middle of a recession doesn't mean you need to abandon your investment strategies. This wisdom is timeless, and it applies to both short-term and long-term investors. Do your research, assess your risks, and continue investing. And here are 5 expert tips on the smartest investments during this time. 1. Buy consumer staples. Every stock is at risk during an economic downturn. Even stocks that don't lose money are at risk of experiencing significantly reduced earnings. However, certain stocks have businesses that are relatively insulated from economic downturns. Consumer staples are historically a good investment during stock market crash. Everyone may buy fewer smartphones or go on fewer vacations during a pandemic, but they will continue to buy food and toilet paper. 2. Buy utilities. It's one of the more defensive sectors to buy during a recession. Like consumer staples, people will continue to keep the lights on and the water flowing in their houses. Many utilities have rates set by regulations, which means their pricing is relatively stable even during a downturn. Also, utility stocks are known for their dividends and can generate income for investors if they pass the dividend risk test. 3. Buy healthcare stocks. The coronavirus pandemic has a negative impact on healthcare just like everything else. Allocating resources to fight the pandemic disrupts other research and development, and there are fewer doctor visits and lower test and prescription volumes, which may reduce billable services. However, that being said, the population continues to age and the demand for healthcare services continues to rise. Innovations in medical technology like 3D printing, robotic surgeries, and artificial intelligence continue to improve results. Also, the importance of medical research and a strong healthcare system has been emphasized because of the pandemic. After this storm weathers, healthcare proposals will be the center of attention for a long time. 4. Invest in precious metals. Things like silver and gold tend to perform well during market slowdowns. However, you need to be smart with the timing. Since the demand for these commodities increases during recessions, their prices go up too. Even though gold generates no earnings and provides no dividends, it's a commodity that can be traded. The more dire the economic situation seems, the more valuable hard assets become. Since investors see gold as a safe haven, its price often rises as market conditions worsen. But as they become more comfortable returning to stocks, they sell their gold investments, which brings the gold price back down. So be smart about this. Study the situation in your country and figure out which phase you're in. 5. Invest in ETFs and mutual funds. Exchange-traded funds, or ETFs for short, are one tool you can use during a recession. It can help reduce exposure to equities at these uncertain times and utilize a flat strategy to allow for risk control. If you're not confident about hand-picking individual stocks, ETFs are a great way to invest money in the stock market. Those were our top 5 smartest investments during this recession. And now it's time for our final tip. Number 7. Keep a long-term perspective. If you're investing in stocks, ETFs, or mutual funds, and you're a long-term investor with a time horizon of 10 or more years, don't let emotions get in the way of your sensible decision-making. Selling all your investments and moving to cash might seem like a safe option, but you'll be missing out on any opportunity that presents itself when the market rebounds. Don't be disheartened if your overall portfolio is currently in negative. This does not mean you've lost money. You only lose money when you close your positions and take out all your money. Eventually, the stock market will rise again, and if your investments are made in healthy companies, you'll be in a profitable position in a few months. Remember, a good investor is a patient investor. Just like you need to save money for an overseas trip or wait another year for your favorite movie sequel to be released, investing is a long-term activity. That's it for this episode. We hope it helps you all out there managing your investments. If you found the information here useful, hit that like button. And if you want to support us even more, buy us a coffee from the link in the description. If you'd like to see more episodes on financial advice, hit that subscribe button and turn on the notifications for our latest updates. Let us know if there's anything in particular you'd like us to make an episode about in the comments section below. We hope you all make it through this crisis with the least amount of losses. Stay safe and good luck.